Good afternoon, everyone, and welcome to our market update. It's been about 6 months since we did one of these before. Usually after reporting season, we like to give our clients and referrers a bit of an update of where the market is. And for that, I'm joined by our Senior Portfolio Manager, Kenneth Bentley. Welcome, mate.
How you going?
Good, thanks. Got to say, I am looking forward to today's discussion. Interesting times, there's no doubt about that.
I think so.
You know, we're seeing government stimulus, support of central bank policy, COVID shutdowns, opening up, vaccine rollouts, strong GDP forecasts, like increasing dividends, commodity prices.
A lot going on.
And overlay that with rising bond yields. So where to from here? So looking forward to a little bit of a clarity for our investors about, you know, what does it all mean and how we should position our portfolios.
Hopefully we can provide it.
Awesome. One other thing we want to do is, you were seeing a lot in the press about rising bond yields and the impact on markets. So hopefully what we can do today is put a little bit of a perspective on that. What does it actually mean? So what does rising bond yields mean? And why does that impact portfolios? How does it impact your portfolio? And how would we position those portfolios? So hopefully there's a little bit of a takeaway for our listeners as well. All right. So we might get started.
Sounds good.
All right. So, usual disclaimer, and let's kick off with the reporting season, Kenneth.
Yeah, I think it's always nice to start off with this particular segment, and it really gives a good picture of how our market has been going. And I've got to say, we've been doing this for a few years now, and this has been one of the most exciting times that I can remember. So if you look through that February reporting season, we would say it's been one of the best in years. Earnings were good. I think importantly though, what's been really, really exciting is the fact that we saw earnings projections going into FY22 and FY23. They've actually been increased. Almost every single time that I've been in here, we've had an earnings per share decline coming off reporting season. So I think that's a really, really good sign.
Certainly something we'd like to see.
Yeah. And I think, again, where we saw some really, really good results, some robust results, materials, fantastic cash flow, commodities have been trending really, really strongly, and we'll touch on that a little bit later. But when you think about why that is, the reflationary type of trade that's going on, it's actually really, really good when you focus on the Australian share market. We're heavy in financials and we're heavy in commodities.
One thing I might just pull you up on there is just to give listeners a bit of explanation about what you mean about a reflationary trade.
Yeah, certainly. So when you think about where we've come from, so COVID-19, one of the worst periods for global growth, even though it was a short period of time, on record. You have to go back to the Great Depression to see some of the global PMIs that we were seeing, some of the unemployment rates. We touched on this in our last presentation, but it almost looks like a data error when you look at the unemployment rate over in the US or the initial jobless claims. They went from roughly 300,000 to over 8 million. This is just incredible. So when you're coming off a low base and you're seeing a deflation, so people holding on to cash, we're coming out of that with huge fiscal support, huge monetary support, got a lot of liquidity going around. And what that means is we're starting to reflate the economy. So just think about it like blowing up a balloon.
Certainly something, a key difference there to inflation.
Yes, and we'll touch on that a little bit later, but it's a great distinction to make. One is a short-term reflation, so we're coming back to where we were. Sustained inflation is a much harder question,
and something that created concern as opposed to something we can enjoy at the moment.
Yeah.
All right.
So a couple of little things. I think that what people most want to see, or the vast majority of people want to see, is dividends. A terrible period for dividends through FY20, and it was really, really good to see a lot of those big mature companies on our market start to give back cash to investors. And then the other area that I thought was really important to touch on was, consumer discretionary, the margins that we were seeing from companies resetting their cost base and being and yes, there was some supply constraints there as well, but it's actually in our view going to drive further upgrades.
All right.
Now the two sections that I'd like to focus on here. One is around that tilt towards value. So we've been in a market where growth has been hard to come by. So the premium that you pay for that has been expanding, and you can see that in that top right hand corner. That grey line there is the top quartile of growth companies on our market, and the huge dispersion between where it typically traded through, the early 2000s, really kicked in through that 2011, 2012 era, and just accelerated. We think that there's an increasing probability that starts to moderate as people go, well, maybe this is as low as bond yields get. Maybe that, there's better opportunities for growth now than rather having to pay for it into the future. So you can see that there's been a decrease in that top quartile. And then if you look at that dark blue line, the financials, which is historically a value orientated sector, you've started to see that creep up. So I think that's really important.
And that's probably something we'll touch on a little bit more when we're looking at rising bond yields and the impact on your portfolio and the markets.
Yeah. Now, on the left-hand side, really what's that showing is the change in earnings, and that's the grey. That, typically we wouldn't see such high levels of earnings growth. It is off a low base, but we're starting to look at, well, when you've seen that change in earnings, the PE is actually contracted because there hasn't been much movement on the capital side. So the valuation that we're starting to attribute to a lot of these sectors isn't demanding. So I think that's another really important factor to have a look at. Why are we excited, and why are we looking into the next 1 to 2 years? Well, I think you need to look at the economy, the global and domestic, and I think it's a really good flow through to have a look at that now.
And I think some of the data coming through, or comments made about our GDP forecast, has been really positive.
Now I will caveat this with, there's going to be some volatility in some of these numbers before I go through them in the next 3 months. We've just had, JobKeeper subside, and we've got debt moratoriums coming off. But when we're looking at some of this data, it's been, some of the best in decades, really. You think back to June, April, May last year, we would have had unemployment, if we didn't have JobKeeper, in double figures. We're now at a point in time where we've got a 5.8% unemployment rate. Participation is reasonable, so it's not as if a lot of people have dropped out of the workforce. Now we couple that with job ads, and I think you come to the same conclusion that really it's looking pretty rosy on an employment outlook. The bottom left-hand corner there, that goes back to 2012 on job ad. Bottom right-hand corner, that goes back to 2012. So we're at a decade high for job ads.
Yep,
incredible.
Now we are mindful that some full-time employment hours may have been reduced, and whether they've been restored or not. But I think the general consensus view is that it's a positive outlook.
And that's supported by what governments both domestically and internationally are doing, and it's great to see that we've got the RBA, or the monetary side of things, and that fiscal side working in unison, which is great. The only other thing that I wanted to touch on here was international borders have been shut for a while. There's been pent up consumer demand, and that's actually been going into the housing sector. People are doing up their homes, renovating, and what we thought we were going to see with home approvals was a sharp decline after the government ceased the $25,000 renovation subsidy. We actually are now, there was a quick decline, and now we're back up to, again, multi-decade highs. And what's lacking there is the apartment side. So we think that's got further to run, but at the moment it's really giving people a wealth effect. Your house prices are going up, you're spending more on it. There's a lot more money in our economy rather than it leaving to go and ski in Europe.
And I think we've seen some of that through other sectors. I mean, you certainly don't want to be trying to buy a boat, caravan, or four-wheel drive at the moment. But but which has been good domestically for us.
Yeah. And it's not just here. Globally, some of those percentages, if you'd asked me 2 years ago, I would have thought were, not real. 5.7% this year for the US, 4% for us, and we think there's a possibility that actually gets revised upwards. But what we're seeing is as the global economy becomes stronger, that demand for raw materials, commodities, energy is starting to push on prices. And then it's really around, and that's the question that you asked before, is it just a reflation to get us back to where we were, or is this going to be sustained? Which is going to be, like I said, a more difficult question to answer. With all this demand for commodities, and where you look at an area of the world where we've really handled COVID-19 well, if you compare us to a lot of other economies, that is placing quite a lot of upward pressure on the Australian dollar. We think that if there wasn't the RBA involved, we'd be looking at the mid 80s to high 90s, and that's from our chief economist. Mid 80s to low 90s. He's still penciling in early 80s for his consensus forecast. But it is something to watch, that if you do hold international holdings, you've got US cash, that it looks like there's upward pressure on the Australian dollar.
And so what some of the impacts that can have is if you do have US exposure in investments, what is the hedging effect that or what are the hedging considerations we should take?
Yeah, it's a great question. I think what we've tried to do is, if we can, and that's the important part to that, if we can, we would hedge our exposure out. So over the last 5 or 6 years, what you've had is a tailwind if you've been holding US-based assets. That means that as the Australian dollar was falling, you're getting a currency uplift to your valuation. Now, over the past 12 months, that's reversed. So if you still held those assets, you've actually seen the Australian dollar move from 60 cents to about 80 cents, roughly. If you manage to hedge out that position, that 30% decrease or effect on your impact on your valuation is actually negated. You've managed to take out the currency risk. So I think where possible, we've been trying to do that. Important to note though, if you hold quality assets, you don't want to be basing a investment decision solely on a cyclical type.
And I think that's an important distinction to make there, is that where possible we have taken hedging positions, but it doesn't mean that we've liquidated those quality assets with US exposure. Right? It is a portfolio position, a long-term portfolio position, and we're mindful of the cyclical nature of currency movements.
So as I touched on before, commodities have been, a really, really strong place to be in, and you expect that. You expect that fiscal stimulus. You've got $3 trillion infrastructure package over in the US. China has been stimulating their economy. Where does that go? It goes for demand into bulk commodities. So things iron ore, copper. Now, where do we go from here? Well, if you look to the left-hand side, that's Chinese crude steel production, and I think it's important to focus on iron ore. It's the bellwether at the moment, and priced in Australian dollar terms, it's at record highs, which is pretty incredible. Now, we actually think that when you look through consensus numbers, and we have access to those, people are already factoring in significant price drops into their forecast for iron ore. So that feeds into the valuations of your BHPs and your Rio. So it's well known, but the price has continued to remain elevated. And I think that if you're looking at margins over in China, they're strong. So these steel mills are still making good money with where iron ore is,
despite the higher prices.
That's right. One thing to note though, and this has happened over the past month and a half, was the fact that over in China there was a decree or a demand that they try and lower emissions. So if you're in a lower quality product, so lower iron ore, that may have a bit more of a volatility into this next 6 to 12 months.
I think the positive aspect of that, Kenneth, is that that just increases the demand for higher grade iron ore, which is positive for the likes of BHP and Rio and Fortescue in our market, particularly BHP and Rio. As the mills are trying to get their emission targets lower.
Yeah, agreed. So I think with the backdrop of how our economy is going, with how the world is going, we're quite positive on commodities.
Yeah, and I saw it come out recently that the imports for China jumped 38% year on year, which is the fastest pace since February 2017. So, which is above market consensus of 23%. So, we're seeing that flow through to that demand for commodities.
Is strong. Yep. Demand is strong. Really topical at the moment, and we thought it appropriate to put something in is the push for green energy and what that is doing to demand for other type of energy products. When we look at the change in government over in the US, it's a lot more favourable towards green energy. Europe has been doing this for quite some time, and that's placing demand for more opaque metals, lithium, nickel, cobalt. All of these are trading at multi-year highs. I think the other area to always focus on is the fact that what is required for the electrification of the world, and you come back to copper. You need copper. The bottom right there is taken from a Macquarie strategy piece, and yes, it's a long time between now and 2030, but the deficit that is required to take on that copper consumption is going to be incredible. It doesn't mean that we're not favourable on LNG or oil. Typically, what you'd see in reflationary type environments, where economic cycles are very, very strong, like the ones that we're in now, those tend to do quite well. It's more that longer term picture where you start to look at the policy and the agendas, and you have to start factoring that in.
Yep. Yeah, there's certainly, we have take a favourable copper exposure. But there's certainly the bullish outlook for the global electric vehicle demand has transformed that lithium market, and the outlook going forward is quite bullish. All right, so everyone's favourite, the dividend income, especially our pension clients, but particularly in this market when we're in a very low cash rate environment, it's hard to find good income returns, and good yields at the moment.
No, agreed, and particularly important because of the lack of income that was produced over the last year. So yes, we've seen a rebound in dividends, which is great. But a lot of people, if you're sitting in cash at the moment, you're effectively taking a negative yield if you include inflation. And so when you're seeing that 0.5% on your term deposit rate, and the inflation is getting to 2 or 3%, that's what's really affecting clients' real purchasing power. I think importantly, if you moved into defensive assets, the fact that bond yields are very, very low. We've actually seen a nice increase over the past really 6 months, maybe about a percentage point, and I will touch on that a little later. But that has the other effect of your capital declining if you're holding that same bond. So you've got to be really cognizant of the fact of what you're holding in this type of environment, in this low interest rate environment, and you want to be focusing on areas where you may be able to protect that cash flow. Get a floating rate note, or look at the subcategories within your overall portfolio and where you can tilt that. So on the next slide, what we can show is just down the bottom is the fact that you can see for each investor, you look at, well, my income return is going to be around about that 3.5%. But if you wanted to, and you kept in that same strategic asset allocation, what you could do is tilt more towards floating rate notes, and you can tilt towards more high yielding equities. And one of the best places to find high yielding equities in the world is the Australian share market. So if you're an international investor, this isn't just domestic. This is a real world problem everywhere. And so when you're looking at where to increase, to tilt your exposure to try and capture your required income, we think that the current setup for the global economy really is favourable for the Australian share market.
One other area I wouldn't mind some comments, Kenneth, is around the potential for special dividends or capital return. Mm-hmm. We've seen strong cash flows within the commodities, your BHPs and Rios and Fortescues, and we've also seen in the financials, with the Tier 1 capital requirements, the excess levels there. If you could maybe some comments around that.
So I think one, yes, through reporting season, the commodities, particularly those focused in iron ore, were fantastic assets to hold for dividend income. What people should always remember, though, is that is a cyclical exposure. And you just have to look back at 2016, where Fortescue didn't pay a dividend, and it was about $1.50. So you've got to remember that, yes, you can increase to some of these areas that have done well, but just making sure that cash flow is sustainable, I think, is really important. Yes, we're favourable on that, but if you're an income investor, what you want to have a look at is, companies that are going to be able to pay through a cycle. So outside BHP and Rio, we would be careful. Now, on your point to the banks, we're actually really excited about this for income-focused investors. We've had a reasonable period for dividends. They weren't as high as what they historically have been, but you'd expect that. JobKeeper's coming off. The debt moratoriums are coming off. So they've sort of kept their ammunition there. The Tier 1 capital adequacy ratios that the banks hold is well and truly over the requirements from the regulator. So we're of the expectation that as the economy improves, you should see those banks either release that capital back to shareholders, which would be a great dividend income, or they go out and try and increase their earnings through other means. But we think that there's a high probability that they remain focused on their core objectives and assets, and that capital comes back in the form of either a special dividend or a capital return. So we've taken an active tilt towards the financials for income-focused investors.
I think from a portfolio perspective, there's some good comments and good takeaways there. Is that when you're looking at, the broader portfolio, is that you are looking for sustainable, and then sustainable income levels. And then when we're talking about then, these sectors that do have strong cash flows, high yields, and then even excess capital, is that you're talking about a tilt, not a complete shift.
Yes.
So you're overweight or underweight in sectors to take advantage of that, but you're not, putting at jeopardy or at risk your broader strategy of sustainable and stronger portfolio construction.
Completely agree.
All right, now this one here, without a doubt, is plenty of coverage, and particularly around tech stocks and higher growth or higher price earnings ratio stocks. And so I think, how does this impact portfolios? Will be a good conversation. So I suppose the first part is you want to just sort of talk a little bit about, bond yields and how they work and their interaction, just to get set the platform.
Yeah. So when you think back a year ago, where people normally go for safety when the economy's not doing well, they go into government bonds and cash. And just to keep in mind that when people buy bonds, the price goes up and the yield goes down. Now, as we've sort of touched on before, the economy is doing rather well, the global economy anyway. So it's being reflated. We've got projections that are being increased, and so people start to look and go, well, what should I be doing with my capital at this point? And if you've got a possibility to go, well, I can try and increase my returns into stocks or other assets, I might move my exposure from my bonds, so they get sold off, and the yields will start to rise.
So just to set that scene a bit more, is that central banks lowered lowered cash rates because of where the economic conditions were. As they start to improve, we're starting to see that relationship change, the inverse relationship, and we start to see, as economies improve or economic conditions improve, a potential rising of rates.
Yeah, the thing to keep note of there is the fact that we do have central banks still being supportive. So they might be able to keep a cash rate down for some period of time, and they might intervene, as they are doing in the bond yield. So it is a moving beast. We're not saying that this will definitely happen.
Yep.
So as you're seeing that, and you're going, well, I no longer have to wait a long period of time to see growth in cash flows, because we previously to this, you're in a low growth environment. Companies weren't doing as well, so people were chasing, and that goes back to that top quartile of growth. People were chasing growth and expanding the multiple because they were looking forward to higher cash flows in the future.
Okay, so when we're looking at those, the bond markets and the equity markets, and particularly the growth market, can you expand further about what that relationship is?
Yes, and what I would like to point to is that bottom left-hand graph. The relationship between earnings now and earnings into the future, the rate at which you discount those cash flows is very, very important. So if you had $1 now and $1 in 10 years' time, if you didn't discount that at all, it would still be the same. It would be zero discount rate, it would be the same. But as you start to increase that rate, and you can see that with the rates of return that we've discounted on the left-hand side, 0, 5, 10, 15, and 20, it becomes less valuable to you now. And bond yields is a part of what goes into discount rates for almost every asset.
So just to reiterate those comments, at a very basic level, equity valuations can be determined by assessing cash flows.
Yes.
So you discount future years' cash flows by an interest rate.
Mm-hmm.
And if interest rates rise, the discount increases, therefore the valuations decrease.
That's the general principle. And on the right-hand side, what we've tried to show is that recent uptick in the bond yields, both in Australia, and the very important one is the US 10-year bond yield, which is really the bellwether for valuations. So that should set the scene, I think. Now, we know that this is happening. You can see on the right-hand side that this has happened before. That is trying to show you the difference between now and the last time, which was in around about 2012 to 2013, what can happen when, or how far bond yields can go. So we completely agree with the view that equities on a general scale will be impacted by these yields rising. What we think is really important to look at is the underlying holdings that can benefit from this. So in inflationary type environments, materials and commodities have done very, very well. The other side to this is financials. They historically perform quite well in inflationary type environments. And of course, value, because when you think about a valuable asset now, where the multiple that you're paying, so the price to earnings is quite low, you've got a cash flow that is very, very close in terms of time to get that cash flow. And then when you compare that to a growth asset, you've got a cash flow that's in a long, long way down the track. So you're not, that discount rate doesn't come into effect as much.
Yeah. So those growth companies, they might make a lot of revenue, but not a lot of profit. Mm-hmm. So these companies, that you're referring to as value companies, because they've got a lot of revenue, sustainable client base, mm-hmm. sustainable income streams, they're less impacted by this rate rise.
Agreed.
Yep. Okay.
One area that we've just spoken about, equities. So if you're holding things on very, very high multiples that you're waiting for those future cash flows to come, they might come under pressure. In the defensive space, so we go back to those bonds and cash. If you're getting a very, very low yield at present, and inflation starts to tick up, you will either have a negative real return in cash, or you'll have a capital deterioration in your bond. Remember the inverse relationship between pricing and yields. We have purposely focused on assets that have floating rate exposure. So you see less volatility in those because the margin that they have is fixed, but the floating rate that they're priced off should be moving in tandem, or maybe not in tandem, but have a high correlation to those inflationary expectations.
Okay, so if we want to build in some takeaways for our listeners, mm-hmm. I suppose the real question, for our listeners is, what's their current exposure? Do they have value exposure or growth exposure, and what those levels are? And I suppose what we're not here to counsel towards not having growth exposure. Yeah. It's more about those extreme exposures. Mm-hmm. And you made a comment earlier that, just like the international exposure with currency, we take the same view with growth exposures. Mm-hmm. here. If they're quality assets and, a dominant position in their space, we'd still like to maintain those exposures. It's more about, how do we rotate the excess from growth into value, mm-hmm. and how do we position the portfolios?
Yeah. In anything that we do, and everyone's different, but in everything that we do, we are founded in valuation. That's our foundation. So what we're really talking about here is exactly what you put, is the tilts, is to make sure that the overall position of that company when you start to run different discount rates through it is not overvalued.
I think the important aspect there is that valuation, we still look at that even in growth companies.
Of course,
yeah,
of course.
And and a way to look through that from a practical perspective is if we look at our healthcare exposure, we're still maintaining healthcare exposure. We may just not be overweight.
That's a perfect way to put it.
All right. Now you'll see some of those comments in there. That's reflected in these are our balanced income growth and ethical models that we operate. Some of those comments that you've been making through with what's been a conducive environment for growth stocks historically. You can see the reflection in these return figures, and also where value and income might come into play, in the shorter dated return figures. We're starting to see that effect as well.
Yeah, we won't touch on any stock specifics, but it's exactly that. So over the last year, we took for an overweight position towards materials. We saw that the fiscal stimulus was coming through. We saw the monetary side was really conducive. And that's actually done really quite well. When you look at, say, the financials, they're coming off such a low base. So COVID-19 brought them to multi-decade lows on any sort of valuation that you would typically look at. And we'll just stick to the majors here. But even before COVID-19, just before that, they were trading at 5-year lows. They had the Royal Commission. There was a lot of government and regulatory pressure on these institutions. We're now seeing that reflationary story come back. We're seeing house prices really increase. The margins that these banks are being able to produce are being very, very supported by the RBA's term funding facility. And this is the first upgrade that we think is going to happen over a good couple of years. So it's tilting that towards that valuation side. That's going to really, we hope, really be supported by the economic environment that we're in.
I know that we're running out of time, so we won't make too much more comment on this. But I do notice that if you look at the 6-month figure here in the income models, starting to outperform the ASX accumulation index, which is supports that discussion as to where we think it's going through. But if you look at a historical 1 year, the growth model has obviously been it's showed extra quite substantial alpha there in their performance. So we'll just fast forward because we do need to wrap this up. What everyone wants to know, where are we focusing now? What's the crystal ball look like?
Yeah, I think we try and look back and see what we were focusing on before. Like I touched on, materials, the healthcare, given the defensive attributes of those equities, and as well as really trying to avoid that what I call growth at all costs. So buying ultra high growth names on some fairly ludicrous multiples, if I had to be honest. But as you said, what are we focusing on now? I think it's really important to try and capture that reflation trade, get in front of that consumer demand and the building infrastructure story. We're almost touched on this on every single slide. Materials and financials really does well, and so we've maintained an overweight position in both of those. What worked really, really well over that past 3 to 6 months was having that exposure to domestic and consumer discretionary, car sales, the house and renovation type story, the hybrid exposure within the defensive assets. So hybrid exposure has that floating rate setup that I was talking about before. Where are we decreasing or trying to avoid? Again, that ultra high growth area. Making sure that we're still holding healthcare in some of our core positions, but just being prudent on the position sizes. as well as we're still not comfortable with that international tourism and leisure story yet.
Awesome. I know we definitely have to wrap this up. So I've just got a couple of quick questions, and they're both currency related.
Okay.
So if we could squeeze these in, and I'll just read both out, and then I'll let you go for it. So the first one is any comments around the Aussie dollar and the UK pound?
Yep.
And the second one is just a clarifications that the research from Morgans is that the Aussie dollar is going to strengthen, or the US will weaken against the Aussie dollar, and comments around what's that 90 cents, and is there a timing around that?
Okay, so I'll touch on the first one first. 3 things to look for when you're looking at currencies: interest rates, budget deficits, and what's driving the economy. In our case, we've got materials exposure in Australia. We've got a potential anyway for higher bond yields than the UK, and then our budget deficit, given what's happening in the resources area, it's actually now going to be a lot smaller than what it was. So we would say that the pound will lose. Just as a general comment, it will weaken against the Australian dollar. Second one was the
90
timing.
cents and the timing.
Yeah. So if you go back towards, if you go back to that statement, it was caveated with the fact that it was unless the RBA was not intervening in the bond market. So we are not calling for a 90-cent Australian dollar against the US dollar. It's 80 cents.
All right, excellent. I really appreciate the chat and discussion today. I hope our listeners had some key takeaways from that. There's our contact details. If anyone would like to have a discussion, I know that you love to chat. So pick up the phone, send an email, and we're very open to discussion. So until next time, look forward to chatting.
Thanks very much for having me. Cheers.
Thanks, Kenneth.